Okay, now few people are as in touch with the finances of everyday Aussies as finance brokers. So joining us to provide an overview on the current state of Aussie household finances is the Managing Director of the Finance Brokers Association of Australia, Peter White. Welcome to the Savings Tip Jar, Peter.
Thanks, Dominic. Pleasure to be here.
Thanks for joining us, Peter. So the first question, bit of a prickly one. There's all this talk about the so-called fixed rate mortgage cliff. What are brokers that you've spoken to noticing right now? Is it a bit of fact or fiction? Aussies or Aussie households well equipped to deal with rolling off their fixed rates that they locked in a few years ago?
Yeah. So Harrison, it's an interesting piece to talk through. So the actual peak of that fixed rate take up was July this year. So we're now just coming over the top of the bell curve, and that's so July 2 years ago is when the majority or the maximum peak of these take up of two fixed rates finished, and then it sort of started to crescendo off there. There's been some conversations in industry media of late from some of the banks saying that a lot of their borrowers have dealt with this very, very well. And I dare say what the banks have done and what they should always do is proactively reach out to the clients that are in that rate bracket before they get the end of it and help them to restructure potentially what is coming. So, whether it's taking up another fixed rate or whether it's going onto a variable rate, it's really subjective to what is in the best interest of that borrower and how that best plays out for them in their circumstances. And although home loans are pretty vanilla, individual circumstances vary. And therefore, you need to get it right. Do you take another fixed rate? How long? If you do, how long do you take it for? Or do you go onto a variable, or what the case may be? And it seems at least some of the banks might have managed that well. We've been speaking with not just our members, but industry at large as we were looming up to this come earlier this year, saying that you need to reach out to your clients and say, look, this is going to look something like this as you come off the back end of it. You're either going to go onto a fixed rate, which is going to be higher than what you're paying now, or you're going to go onto a variable rate that's going to be higher than what you're paying now and could be a lot higher depending on what that variable rate looks like. So the best thing is to work with your client and say, let's rework your monthly payments on that higher interest rate now, even though it doesn't apply, and pay what you normally pay, but take that difference and put it somewhere else where you don't see it. Put it in a bank account, shit into offset, whatever, but put it somewhere else and don't spend it so you get used to not having it. So that when you come off the fixed rate, regardless of what you do, it's not going to be a real nasty shock. If you because if everybody's like me, you tend to spend what you get. Most people tend to do that, and that's not really where you want to be in this sort of marketplace because it is very unusual. This is my 45th year in this industry.
Wow.
And I've been through GFCs and recessions and you name it, I've been through it. And this is very unusual to any other time in history. So it's something that needs careful navigation, but needs a lot of common sense. So the common sense approach is what we took and said, look, treat it like you don't have that money now and get used to balancing your books, balancing your expenditures, your spending habits accordingly, so that once you step off, it's not such a nasty shock. And I think the combination of all those sorts of things, those style of conversations and the banks being proactive and lenders in general that maybe are not ADIs as such, has helped to reduce the impact because we did a survey back, well, it's probably 2 years ago now, as a predictive piece that says, hey, we have been in this low interest rate environment for a horribly long time. And given the couple of decades or more I've been in this industry, we knew rates were always going up. And we said, look, what we've tried to find out through the research is where is your pain point? Where is it the point that you cannot make your payments? And it generally came back as 1% increase or $300 a month. And we did that both based on rental payments and based on mortgage repayments. And that's where the stress point was. So we're now 4 times that. And so we revisited that piece earlier this year and we said, look, interest rates have gone up what they have. How have you managed? And so people had renegotiated with their banks. People had sold assets. They'd taken on second jobs. They had used up their cash in the bank or redraws or offset accounts. They'd done all these things possible to make sure they kept managing it. So when whether they'd already come off their fixed rates, the bell curve, there's a run up to it, hit the peak, and there's a run off. So we're now at the top of the run off, and that'll go to the better part of the end of the year. People have done lots of things to manage it. That's where there was a bit of a slap in the face by the Reserve Bank governors saying, it was only a few months ago now, people need to do this, this, and this, get a second job, sell assets. But they'd already done it, mate.
Already done it, yeah.
Yeah, already done it. So where to now? And I spoke at a Senate inquiry into affordability, a Senate Select Committee, I should say. And, they'd heard my comments on other things around this. I'm pretty sure we'll probably talk about it a bit later. But, I said at the moment, people have stretched that rubber band. The research shows they have done all these things. We get more interest rate increases. What do you think is going to happen? Snap the rubber band. So we're at the point where we weren't 100% sure, but were we at that full tension of the rubber band, or was there a little bit flex in it? And we've seen that given so far, and there is a drag on this, but given so far, there hasn't been a rapid escalation in hardships with banks, right? That people have managed, but we're not at the end of it yet. So we'll see how we go in regards to how that plays out. I think Aussies have been amazingly resilient through something that is very unique in our lending history.
So, Peter, much of the talk about the mortgage cliff was in the media, and it was perhaps a bit overhyped, talking about how we're probably going to see a surge in arrears and people having to, be tossed out of their homes and house prices collapsing. Would you say, maybe it's a bit too early to tell, but would you say it seems like Australians are by and large going to sail through this storm pretty well?
Well, I think the majority of people will get through it a lot better than expected. And although we can sort of be a little bit negative to the media by making a lot of hype out of this, we're in the mix of that, because by bringing awareness to it helps people to, wake up, get your head out of the cloud sort of stuff. You need to look at this before it bites you on the butt, and things become terribly, terribly wrong in your world. So it became a very important awareness piece that this thing was spoken about. And I think through that, Aussies in generally have fared significantly better than any of us expected. And like I said, there's still a bit more to come yet. And hopefully those people manage things in a similar vein. But there's always going to be some cases that don't work out so well. Some people are not going to be able to manage it. Some people are going to find themselves in certain postcode areas where property prices have skyrocketed and then pulled back again, and the world's a bit disastrous. And for those people, they actually need to manage their destiny. Don't let the bank take it over. Don't let the bank put you into mortgagee in possession and try and sell your house for you. Because if you do that, then you wind up with nothing. You wind up with a bad credit rating, you lose any equity, and life is really crap for quite some time. If you look after and you run that process yourself, and I've said this on radio and TV many times through this period, is that if you control your destiny, you'll protect your credit rating, you'll get the equity that's left out of your home, and you'll live to play another day very, very easily and very soon. So there's not a lot of people, I think, these days now that are going to wind up in that boat, but for a period of time, there's quite a few people that could likely wind up in that situation. So, I think Aussies have done an amazing job. There's still going to be some tough cases in certain places, and they really are. Some people say to me, Pete, what's going to happen in this suburb or this state or whatever? You can't pick it that way. House property price movements almost become very subjective to postcode allocations. And in the case where I live in Brisbane, which side of the street you're on? I live on Brisbane River, and the side of the street I live on floods versus the other side of the street that doesn't. And there's a whole host of different dynamics that play in relationship to that. So it's, anybody who sort of gives broad brush approaches to property, I think, has got it wrong. It is very, very unique to that sort of finite sort of detail as to what will happen with people. And people are best judged to look at their own suburbs to say what's happening around me, and then make a determination on what the market looks like there, and take the best steps forward. And, if you're in a situation where your interest rate's looking pretty ordinary, then you need to look around and find an alternative.
Sure. We actually didn't realize that you were in Brisbane, Peter. Because we're Brisbane based too. We could have got you in our office in person. So maybe next time. We'll move to it kind of feeds into the whole, fixed rate mortgage cliff recently. You've probably noticed that banks have lowered their serviceability buffer for refinances, and that's down from 3% now. You've been pretty vocal in the past about having a sort of more official lower buffer rather than banks just applying it as a uniform rule. So why should APRA lower it? And is there any chance they will, noting that they increased it to 3%, citing financial stability, I think nearly a couple of years ago now?
Correct. So with the whole buffer rate conversation, again, it plays back to what we're talking about media and public awareness. If I can see now, if the FBAA hadn't spoken out about this, if I hadn't been on national TV and radio, I don't think the banks would have done anything, to be honest with you, because they were forced to, and there was that much public pressure and conversation around it that they made some early steps that aren't good enough. And again, on public record for that, but they are first steps in my mind. So APRA has a provision that sort of says, in a layman's term, you can't do this all the time, but if you feel there are certain circumstances, you can lower that buffer rate. And some of the ADIs have taken that option, but it's in a very, very restrictive parameter. It's not like it's open to anyone, and they all vary a little bit, but it's a good first step. It's just not far enough, which is why I have written submissions to the Treasurer, Jim Chalmers, and also the Financial Services Minister, Stephen Jones, petitioning that this be made more suitable to the time of need. Now, from what I've seen over all these years, there is no driven process for APRA to review buffer rates, servicing rates. And the two things I've asked for is, one, there needs to be a process-driven review. So whether that's every year, probably annually, unless there is an abnormality in the marketplace, then it needs to be reviewed and assessed to say it is still fit for purpose. Because I don't believe in what we've been going through, the 3% hasn't been fit for purpose. And we can see that, otherwise the banks wouldn't have adjusted some of them, right? Some of their 1% capabilities. So to me, it's a fit for purpose test that's driven by a process that doesn't exist, because you mentioned before it was lifted a few years ago. That was because of a circumstance. It always seems to be when then something goes left of centre, all of a sudden there is pressure, focus, however you want to look at it, for this dial to be moved to make it more appropriate for the needs of the day. And I think that needs to be process-driven. And it may mean at times it just doesn't move. No one's saying it has to. But when we've been through what we are, and I mentioned before about speaking at the Senate Select Committee on housing affordability, that, I was actually quizzed at that particular Senate inquiry that did I still believe it should be down around 1.5%? And my view was, as a broad brush, so for everyone, not in select circumstances, that I believe it is probably somewhere between 1% to 2% is the servicing buffer rate. 1% in certain circumstances makes sense. And the lower end of my 1.5 to 2, so call it 1.5%, was really about if you're already in the system, you're an existing borrower and you're not increasing your debt, you are not changing the dynamics of debt or risk in the totality of the industry. Because you're already there, you're in it. So why not reduce the servicing buffer rate? It's just a calculation to be able to get an approval, right? Because the rate you're going to pay is going to be less anyhow. So why disadvantage people by not allowing that to play out? Because you're already in the system. Different if you want to increase that, different if you're coming in for the first time. That's not what it's about, right? But the limitation that we've had is so much more restrictive than that thought process. I don't know how many people it really benefits. It'd be interesting to see, and I doubt we ever will, is the data that sits off the back of that to say this is the impact of what this 1% servicing buffer rate on a select amount of people had. I don't think it's going to have a huge impact. It will certainly help some, but we need to help a lot more than just that. Because it's unfair to think that all these people who spent all their savings, sold assets, got second jobs just to cope. There's a better way to do it.
I guess, Peter, the 3% serviceability buffer is there in case the RBA decides to put up interest rates a further 3 percentage points or 300 basis points. But I guess with us, a lot of people saying now that we might be at the peak of the cash rates increase cycle. Do you think, well, what's your views on that? I mean, perhaps that feeds in more to the argument that the buffer should be lowered if interest rates aren't going to or are very unlikely to go up another 300 basis points. So do you think the interest rates have peaked?
I believe so. I mean, don't get me wrong. RBA's never put up interest rates at 300 basis points in one jump. So that is a highly, highly, highly unlikely thing to see in my 45th year of being in this industry. Never seen that happen. Seen regular jumps, right, but not one big jump. And the reality is, when we look globally at what's happening, we hope that, from my point of view, I think we have hit the peak. I am still yet to see any further justifications of any more increases in the cash rate as it is at the moment. But a part of that's also impacted on global cost of funds. So banks who and non-banks who securitize assets into the bond market through securitization vehicles are having to deal with what's happening with international marketplace for being able to purchase bonds or sell bonds into the marketplace, and how that comes in as a cost of funds as such. So there's still other influences in the marketplace outside of our economy, and it comes down to that securitization cost of funds piece. But I think that, if it happens again, there's only another 25 basis points in it. My gut says at the moment it won't happen. Our own economies look like they're correcting and stabilizing enough to say, well, you still need to pause. And we were the ones that have been calling for a pause on this review for quite some time, because we were never allowed to see the full impact of the human data that was being played out in this gig. So that when they were making their decisions every month, it was looking at the economic data that was around 2 to 3 months old, sometimes possibly even more. So it was never up to date. And the problem is that the poor borrower, every time there was a rate increase, they're trying to make adjustments, and they took a breath, and all of a sudden there's another adjustment to make, so the rate went up, and they could never catch their breath on this. So it started to drag the outcome of the humanization of what was happening, what I call the human data, out the back of this. And so by pausing, you get to see that flow and effect, because when it comes to financial hardship, you've got probably anywhere from a 3 to 6 months drag before you see that in the marketplace. So this constantly ratcheting was problematic to say, well, you're going to create a bigger problem possibly than what should be there, because if people could refinance now under better servicing buffer rates, they possibly would not be in that financial hardship position. There were opportunities that could have happened that weren't allowed to happen because this rabbit kept jumping every time and you couldn't catch it. So now I think with a couple of pauses, we can start to see what that data looks like, and what the data is showing, and even the human data says there's not a lot of escalation of arrears and financial hardship at the moment. So that's a good thing. We're looking at what's happening with CPI and inflation, and that's coming back. If these things keep trending in these sorts of directions, then there is no reason to put up interest rates. Rather, as we get into the new year, we need to start bringing interest rates down. It probably won't happen till the latter part of the first half of 2024, but it is the year where interest rates need to start to scale back down again, assuming everything else plays out all right at the moment. At the moment, the trend is that way. So, yeah, I don't think there should be another interest rate. I feel there won't be, unless there's something that happens in international markets that has an impact on it, that's not having a further impact on what's happening now, and that our inflationary rate and other measures have been taken or play out in a balanced way that says to all those that make the decisions, let's not do anything just yet.
Peter, on that, we've had previous guests on this program talking about the idea of an insurance cash rate rise. We've seen I think the European Central Bank has done one more. The Bank of New Zealand is kind of still hiking, even though their economic indicators are showing signs of, coming down, inflation's coming down and whatnot. But you kind of said previously that Australian households are still very well placed to withstand, rate rises. Arrears are very low. So just explain that a bit more in terms of like, why can't Australia deal with a few more rate rises to really truly stamp out the inflation problem? Do people have short memories? Because inflation has been low for 30 years, and you would have seen in your 45 years of experience, the ebbs and flows of inflation in the late 80s and so on. So why can't Australian households sort of withstand a few extra rate rises?
So I talk about that human data piece versus the economic data that is a lot older, and the human piece is a lot more current. That if inflation is showing that it's trending back and that data is not necessarily right this minute, then we still don't know how much more it's coming down. If it's coming down, it's coming down. It's heading in the right direction. So therefore, where is the justification to keep hiking rates? I have been saying for 2.5 years that the fixed rate, that the retail fixed rate should be somewhere between 6 and 7%. This is way before we got here, right? That's not the cash rate. That's what the bank would charge, between 6 to 7%, which is pretty much where we are today. And what it does, it creates a harmonic balance in that it's not too low that it can't be sustained. It's not too high that it craps on all the marketplace and no one can afford it. It gives you that balance of scale. And over all these years, and there's various economic pieces that come into play. So I can go back when I first started my retail banking career, and I was a lending officer back in the early 80s, doing home loans at 18.5%.
Wow.
18.5%. Now, we're never going to get there again, but also the average house was probably 50 grand, right? Very different dynamics in economies. But the principles still play out, is that we're heading in the right direction. We need to make sure that we don't do something to stop that correction by jumping too soon on the next marketplace. And the other thing we've got to watch is this isn't just about inflation. We've come into this off the back of a global pandemic. Now, a lot of countries have suffered a lot worse than Australia did through the pandemic. And therefore, our financial economic resilience has been far better than many countries around the world. So therefore, we're better placed, not expecting, but better placed to take on this next challenge straight out of the pandemic, to inflation skyrocketing through the roof, to be able to then, turn it around and bring it back into play. So they're my reasons why I believe this. We are well placed in Australia. Like I said, it doesn't mean everybody gets out scot-free. It's not necessarily a perfect science, but I think we are better placed than anywhere else in the world by what I see. And I also, you guys may not be aware, I chair an international federation for mortgage broking called the IMBF. It's the only one in the world. We have 6 countries collaborating in conversations, and we meet monthly. So I see what's happening around the world every month, let alone the news bulletins I get every day from around the world. And I look at that and assess where we are in Australia and say, we are in the lucky country, even though it's been hard for so many people. But we are the best place to get through this in the best light.
Before we wrap up, I just want to get a bit of a take on the mortgage prisoner effect, which is another thing that we've heard a lot about in the media, talking about, obviously with the rates being a lot higher and the 3% buffer still being in place, how people are locked into the current mortgages. Just exactly, based on your conversations with brokers within your association, how prevalent is this issue? Are there many? Do you have a rough idea of how many people actually are currently mortgage prisoners?
When you look at the data that sits from the Reserve Bank on the difference between the new broker rate, the new borrower rate versus the existing borrower rate, historically it was around 45 to 50 basis points. Now that's starting to narrow in. So it's around 40 basis points at the moment, which is an unusual trend. But again, this is why talking in the media has such a powerful effect, because until we start speaking in the media, and I can track it off the Reserve Bank's data, nothing was changing. It still had this big gap. Now, that's on an average basis. That's not an individual basis. So again, the part of the petitioning that we put to the Treasurer and to the Financial Services Minister, there needs to be transparency around what the existing borrower rate is, because it's entrapping people. It's trapping them, they can't move, and they become prisoners in that mortgage. Because 2 months ago, I was on air to a radio station that was playing nationally, and it was a live call-in by borrowers. Now, this was a few months ago now, and a borrower rang up and said he was paying 7.8%. They probably should have been paying early 6s or maybe late 5s. 7.8. Now, very difficult for him to get out of it because where he was and structure and so on. But also, too, the 3% buffer rate was prohibiting him from doing anything because
10.8.
There wasn't all the there also wasn't all the calls that are the if you noticed at the moment, the cash incentives have gone, but the rates are coming down for the new borrower rates. So they're sort of flicking one around for the other. We didn't have that before. They were saying, we're going to charge this rate and here's a bucket full of money. And people going, ooh, happy days, and spending it on holidays and goodness knows what, for those who could afford to do it. But the bigger problem was with the mortgage prisoners that were getting trapped, that were paying excessive amounts of interest because they couldn't finance out elsewhere because of the buffer rate risk causing the restriction to move, right? And that's meant that the banks could basically charge what they like on the existing portfolio, what we in the industry call the back book or the existing borrower book, right? They could charge what they like because they couldn't get out, so you're trapped, you own it. Now, I've got meetings coming up with the federal minister further around this because the final piece that we called out for was transparency in all advertising when banks in particular, because they're probably the worst at this than anyone else, and it applies to all lenders, that when you advertise this is the rate for new borrowers, you must advertise what the rate is for existing borrowers. To be very transparent as to this is good because it's the same. This is where we're seeing that borrower and new existing borrower and new borrower rate starting to come together a bit, which is an unusual point in time because they can see this is coming, that there needs to be transparency about it. Just be honest. In the old days, and if I go back into the early 2000 era and lending through there, and also through the around the late 1990s, it was very big to have honeymoon rates, where it's very transparent. So I'm going to give you this rate, but it's 1% below the existing borrower rate. And when you come off the honeymoon rate in 12 months' time, expect your rate will go up to 1%, to whatever the existing borrower rate is at the day, right? It was transparent. If you liked it, great. If you didn't, you didn't do it. At the moment, people aren't being given choice because there's no transparency around it. So we've asked the Treasurer, in actual fact, I was at breakfast with him in Melbourne a few weeks ago, and we're talking more on this, even though I put it in a submission, a petition to them. And I'm now about to step into conversations with, I won't name names, but with a very senior portfolio minister to make sure that we bring into this particular piece that transparency. We went through the Haynes Royal Commission, what was it now? Almost 5 years ago. How time flies. But one of the principal outcomes of that was that trust is created through transparency, the truth, right? How would you like to go to a new bank going, I've got the best deal, really great interest rate, and find over 6 to 12 months' time, your rate starts creeping up and you can't stop it and it keeps going. It might be little bits, but little bits all the time. Yeah. You'd be feeling pretty lousy about what you thought was a good deal. And then all of a sudden, guess what? You're stuck. So this is where 3% I don't believe is reasonable. We're never going to go another 300 basis points. I'm certainly not advocating for zero. That doesn't make sense. But it needs to be assessed regularly so it's fit for purpose. So as markets look like they're shooting up, it may need to increase. As markets seem to contract, it needs to be reduced. It needs to have that elasticity in it driven by a process-driven review. That makes sense and makes sure that it's fit for purpose of the day.
For sure, Peter White. That might be what the RBA governor's messaging is all about, the so-called soft landing. That's about all we have time for on the Savings Tip Jar podcast. Peter, thanks for joining us once again.
Harrison, Dominic, my pleasure. Thanks so much for having us.